Okay, hello everyone. This is Rod from BTA. Let's take a moment to look at the disclaimer. This content is for educational, informational, entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to tell you how BTA looks at the market, how we analyze the markets, and nothing should be taken as a recommendation. This is Rod from BTA, and we are the middle traders. What we're going to do in this video is go over our Bollinger Band, our weekly Bollinger Band RSI stochastic MACD strategy. Okay, we know that last week, the previous week, the week before last, we got our pivot week. Okay, we got our last week was our pivot week. The week before that was our signal week. Okay, so we still in the pivot week. So last week was the pivot week, but no day within that week could we close above the high, the close of the signal week, the pivot. So the close of the signal week was our pivot. No week last week during our pivot week could we close above that close. Okay, we could not close above that close. We traded above it a couple of days during the week, but we never closed above that close. So we could not take action. And besides that, remember we was talking about the 8-week moving average that was giving us a problem, right? The 8-week moving average was giving us a problem. It was holding as resistance. Okay, we could not close. We could not get a close above that 8-week, and the volume just was not coming in. So we did not take any trades last week according to the Bollinger Band, the weekly Bollinger Band strategy. So let's go over. This is a daily chart of the DIA. This is a weekly chart because we're looking at our weekly Bollinger Band strategy. I apologize. This is a weekly chart of the DIA. Okay, a weekly chart of DIA. And this week here, you know what? Let me zoom in. Let me zoom in a little bit so I know everyone can see it very clearly. Let's zoom in a little bit on this price action right here. Okay. Now, this week right here, okay, was our signal week. Okay, that was our signal week. And for the DIA, it closed on the signal week, okay, at 332.07. That was our pivot. 332.07. That's the pivot close of the signal week. Okay, last week was our pivot week. But like I said, no day during the trading last week did we close above the close of the signal week, which was our pivot, that 332.07. We traded above it a couple of times. We might have just barely closed above it on one of the ETFs. I can't remember. But in any case, we could not close above that 8-week moving average. We had that downward trending 8-week moving average that was right over price. Okay, right over price, our pivot level as our overhead resistance, that 8-week moving average. We could not get above that 8-week moving average on the weekly charts. So because of that, we did not want to take the trade even when it broke above the pivot point, okay, of our signal week. We did not want to take that trade, okay, because we could not get above that downward trending 8-week moving average. We talked about it all day last week, all week last week. We talked about it almost every day, all week last week as overhead resistance. We could not close above that. So because of that, we did not want to take a trade on the weekly Bollinger Band strategy. And also, all week last week, we spoke about the fact that the volume was not coming in. Very low volume. The volume was not coming in. So because of that, we did not want to take the trade on the weekly Bollinger Band strategy. Okay, even if the pivot was being broken and we're going to close above the pivot, we still cannot close above that 8-week moving average, okay? We could not get a close any day last week on above that 8-week moving average. That was the overhead resistance. So because of the overhead resistance of the 8-week moving average and the lack of volume that was coming in each day, the volume was not coming in above average. We barely get higher volume than the previous day. The volume just was not there. We kept monitoring the on-balance volume, our line charts of closing prices and the on-balance volume, and we just cannot see the volume coming in on the on-balance volume chart either. So it told us that the volume was just not there, and we could not get above that 8-week moving average overhead resistance, so we did not trade last week. So now that brings us to the week coming up, okay? Today is 6/5/2022. Tomorrow, which is going to be Monday, 6/6/2022, starting a new week. Let's see what happens. But let's look at the weekly chart of the DIA for right now. So like I said before, this was our signal week. And the close of our signal week, which is going to be our pivot point, okay, for the DIA, is 332.07. All right, we're right below that right now. Okay, we at 329.35. Okay, so we're going to need to break above the pivot, one, and we're going to need to get above that 8-week moving average, which is number 2. And also, I forgot to mention, we had that 21-day moving average on the daily chart, the 21-day moving average acting as support. So we're going to monitor that also in the upcoming week. But for right now, we need to get above. For now, right now, what I want to make sure I explain to everyone, we need to get above. We need to get close above. We need to see one day, any day that we can close above the 332.07 level, which would be the close of the signal week. Okay, we can close above that, then that'll be our pivot point. We hit the pivot, but we also want to get above that 8-week moving average. Okay, that 8-week moving average on the weekly chart, and we want to monitor very closely because it's starting to come into play now. But it's because prices are moving sideways and that moving average is moving down. That is the 50-day moving average. So we got the 21-day moving average acting as support on the daily chart. And we got the 50-day moving average that's sitting right above all of the major index ETFs. The 50-day moving average is sitting right above it, acting as overhead resistance. So we got the 8-week moving average and we got the 50-day moving average. I hope I said 50-day before. 50-day moving average sitting right above price. So even when we do get a day, any day next week, where we close while the price action is trading all through next week, if we close above the close of the signal week, which is going to be our pivot at 332.07 for the DIA, we need to get above the 8-week. Okay, we need to get above the 8-week moving average, and we're going to need to monitor very closely how close we are to the 50-day moving average, because if we right on top of if the 50-day is right over price, right near the pivot, then we're going to wait until we get clear that 50-day also. But we'll be going through this stuff every day next week to see what happens, okay? And if we take action, we're going to let everybody know. But now, below that, it's the support of the 21-day moving average, and we got lowest. We got lowest right below. If we start breaking below lowest in the 21-day moving average, we're not going to take any trades no matter what, okay? Because that means that we're breaking support and prices are probably moving down, all right? So now, the trade is if we can get some upward movement, if we could get some volume coming in, we could get above the 8-week and if we have to break above the 50-day moving average, okay? If all that can happen, the trade is actually a lot safer now, okay? The trade is actually a lot safer now because the pivot is than it was before, than it was last week, because our risk is lower now. Because this week, okay, the upcoming week, well, let's go back a little bit. Last week, the spreads were very large, Okay, we have very big spreads. On the DIA, the spread from the pivot point to the low, okay, the pivot point to the low, okay, of our second stop loss, right? Our second stop loss. The pivot point, from the pivot point to our second stop loss, all right, the spread was almost an $18.45 possible loss. That was $18.45 exposure. We talked about how big the spread was. That's why we jumped down to the daily chart and we were going to use the 21-day moving average instead of the $18, instead of the low of the week. We're going to use the 21-day moving average because that made the spread a lot smaller. And that made our risk, okay, our risk from the pivot point to the break of the 21-day moving average, our risk was a lot lower. Okay, it was going down now to $6.68. That was last week. Now this week, okay, the majority of the ETFs, right, the index ETFs, are also giving us some some better stop loss areas, okay, because the spread is a lot tighter now, okay. The spread between the pivot point and the low of last week, okay, the spread is a lot tighter now. If you notice here, the low of last week was 325.36 for the DIA. And that's going to be remember, according to our Bollinger Band trading plan, our weekly Bollinger Band strategy trading plan, prices should never close below the low of any previous week, right? If it does, that's our get out automatically out, no questions asked. So just say if we took a trade in this week, prices should never close below this week. As the next week go, prices never should close below this week. So now we got the upcoming week, prices are going to be moving over here. It should never close below this week. Anytime that happens, that's our automatic out, stop loss, maximum loss, out, no questions asked, right? So this has made the Bollinger Band strategy itself a lot safer, okay? It's extremely safe now. It's almost as safe as it was when we jumped down to the 21-day moving average as our stop because the spread was too large. Now it's not extremely safe. It makes it a lot less risk. In other words, what I'm saying, it's a lot less risk. It's not. I shouldn't have said extremely safe. If I said that, it's safer. It's a lot less risk now at play because the spread between the pivot point and the low, which is our maximum stop loss, our out, get out no matter what level, okay, is a lot tighter, okay, because right now, if you take the close, the pivot week close, and you take the low, okay, the low of last week, which is 325.36, okay, and the pivot week close was 332.07, that's a spread of $6.71. That's a spread of $6.71. $6.71. Okay, that's almost close to the spread we created last week by going down to the daily chart. Okay, and using the 21-day moving average. Last week our spread was $6.68. So now the weekly Bollinger Band strategy now is set up where we don't even have to jump down if we don't want to the daily chart of the 21-day moving average to get a tighter stop to reduce our risk. Right now, the Bollinger Band strategy, the weekly Bollinger Band strategy, is actually reducing the risk right now because last week's trading range was so tight. Okay, last week's trading range was so tight that now the risk is a lot less because from the pivot point to the close, the low, the very low of last week, we only have a spread of $6.71. So that's our maximum loss right now. We're going to get out. We have an exposure of $6.71 as our maximum loss. So now that's a lot tighter. I like that. That's a lot tighter. That's what I wanted to see. a tight stop, not too wide, a tight stop. We don't want to take big losses. So now with that being said, okay, let's just go over the DIA real quick to make sure everybody is clear on what we plan on doing here at BTA. Like I always say, nothing's a recommendation to buy or sell anything. I'm just a guy telling you how we trade, okay, how we look at it at BTA. We learned from some of the best, very successful. So I'm trying to pass on that information. I want you to look at it for yourself, make your own decisions. Okay, so here's a weekly chart of the DIA. Okay, last week's the week before last, which was the signal week. Like I said, the close of the high of the signal week it almost closed on the high, but the close for the DIA for the signal week was 332.07. Okay, that's our pivot point. If we break above, so now we got this week's trading action. If we break above 332.07, that's the pivot, right? That's going to be the pivot. If we can close above it, that'll be the pivot. And we want to also look at that 8-week moving average. We want to get above the 8-week moving average. We got to get above the 8-week moving average and have a day where we close above the 8-week moving average. Now, if the 50-day moving average is very close to that, like I said, we're going to wait. All right? If the 50-day moving average is very close to that level, we're going to wait until we can get a close above the 50-day. If the 50-day is further enough away, we'll just go ahead and take the trade at the pivot. If the volume at the pivot and when we break above the 8-week moving average, we got to get above that. That was the one that held us last week. We need to get above that, okay? The 8-week moving average, all right? So if we could close above the pivot and close above the 8-week moving average on any day, and we see some volume coming in, all right, volume coming in on that day, then that's going to be the day that we take the trade, okay? We'll take the trade on that day, and we'll be going in, all right? But we'll keep everybody updated on what we plan on doing. But that's what we're going to be looking at, a close above the 8-week, a close above the pivot, and we need to see that volume coming in. If the 50-day moving average is downward trending 50-day moving average on the daily chart, it's very close to price, then we're going to wait for it to get a close above the 8, close above the 50 for a safer trade, and then we're going to fall right back into our Bollinger Band trading plan and use the first stop and the second stop. The second stop, which is our maximum loss, like I said, it's going to be the low of last week, which is 325.36, and that'll be a spread from the pivot point to that low of $6.71. Okay, that'll be a spread of $6.71. So now let's minimize this, right? Let's take some of these lines off of the chart, right? So we got our Bollinger Band strategy here. We got the lower band, we got the middle point, and the upper band, right? So as we can see, here's the lower band. The strategy is in play right now. That's obvious. We already spoke about that. Here's the RSI down here. We did recycle below 30 to the overbought. We got above 30. Prices is moving up, but we stalling. We stalling right here at the 50 level. Now we want to get above 50. We want to get above 50 because that's putting us on the right side of the playing field. That's putting us on the side where the buyers and the bulls are now taking control of the momentum. Right now we're below 50, so the buyers have not really taken control. And as you can see here, notice that since the start of the year, since 2022, since the start of the year, we got below 50, the 50 level, this horizontal dash line. We got below the 50 level, and we have not been able to get above it. We have not been able to get above it, and we're not getting above it now. We have 43.78. So as prices, if we're fortunate enough for prices to start moving up next week, in next week's trading, right, and we get above the pivot point, we get above that 8-week moving average, okay. Hopefully this RSI can start getting above 50. That would be a very positive sign. And then we want the stochastic down below because it had given us the bullish crossover right here. The blue line crossed above the red. It's clearly back above the 20 level. We at 37.72. So if hopefully that can move up and get above the 50 level too, because that's telling us that prices are closing higher and higher within this range, higher and higher within this range. So that's the DIA. Okay, that's the DIA. That's what we're looking at on the weekly chart. Now let's very quickly go down to the let's minimize this. Let's go down to the let's not go down. Let's go over and look at our moving averages. Okay, right here, our moving averages on the weekly chart. So this is the weekly chart of the DIA, and here is our moving averages, right? Okay, so we got the 4-week, which is the white line. This is the 4-week moving average, the white line. Okay, here's the 4-week moving average right here. Okay, and then here's that 8-week moving average, the green line right here. That 8-week moving average right here. Okay, for the DIA. And that 8-week moving average is at 329.35. Okay, 329.35. Our pivot point, okay, is 332.87. Okay, so 329 just a little bit below our pivot point. All right, now we need to get above that 8-week moving average, and we need to close above that 8-week moving average. We need to see a close above that 8-week moving average. So right now, if we close above the pivot point, okay, which is okay, we could think about it like this also. If we close above the pivot point, which is 332.07, we're going to automatically be above that 8-week moving average, because right now it's at 329.35. So a close above the pivot point is going to put us above the 8-week moving average, okay, which is at 332. The 8-week moving average is at 329.35. The pivot point is 332. Now we got some issues up here. Look at that 13-week moving average. It's at 335. It's at 335.27. That 8-week moving average is at 335.27. We're going to be monitoring that that 13-week moving average. The yellow line is a 13-week moving average, okay? It's at 335. The pivot is at 332. Okay, so these moving averages, these overhead resistance areas, these moving averages are starting to squeeze in on price. This is going to be a lot of overhead resistance. We're going to have to watch this very carefully, okay, before we take a trade. Because look, if we hit the pivot point at 325.36, right? I mean at 332.07. If we hit the pivot point at 332.07, which would be the high of this week, the close of this week right here. Okay, let's put a line. Let's put a horizontal line across there. Okay, let's put a horizontal line across there. So just say somewhere right there in that area. It's not exact for right now, but just say somewhere in that area, right? If we hit this pivot point and we break above the pivot point, which is horizontal line right here, is representing the pivot point for right now. That's at 332.07. This down, okay, good. We'll be above the 8-week moving average. We'll close above that, and we'll be closing above the pivot. But look at this yellow line, this yellow moving average right here. That's the 13-week moving average. That's the moving average price over. That's the average price over the last 13 weeks, the last 3 months, the last quarter. That's at 335. That's at 335.27. So if we hit the pivot at 332, listen, we only got $2 before we run into a really strong overhead resistance level. So this is starting to be a little troublesome, okay? Because we could trade right up to that and bump our head. So when we get into this trade, we know we only got about $2 before we're going to come into some really overhead resistance, okay? So we got to monitor this very closely, keep our stops very tight. If we start getting rejected off of this 13-week moving average, okay? If we start getting rejection, in other words, we trade up to that 13-week moving average, prices start breaking back down and start closing back below the low of closing back below our pivot point, that might be a sign that this thing is getting rejected. Okay, so we need to keep a very close eye on that. You know what I'm saying? It might not be even worth waiting for it to come all the way down to our maximum loss breaking the low of this week, right here, because it's telling us that it's probably going to get, if prices run up to the 13-week moving average and get rejected and start coming down and break back below the pivot, then it's a really good chance that it might break back below the 8-week moving average. If it does that and close it below the 8-week moving average, why wait until it get all the way down to the second stop loss? And one thing is for sure, the second stop loss is right on the 100-week moving average. This magenta purplish looking line, that's right on the 100-week moving average. Okay, that's key. That 100-week moving average is serious. Okay, so we gotta watch this. And right below the 100-week, we got the 4-week moving average, our faster moving average right below it. So look, this our stops up. We have, like I said earlier, we got some pretty good levels for a pretty tight stop. Okay, but we got some things happening here that we might not even have to wait for it to get that low. We might could get out a lot sooner. Okay, so we're going to be monitoring that because that 13-week moving average right overhead. Okay, that yellow line, which is 13 moving average, right, 13-week moving average is right over our head. So listen, we want to keep an eye on that and watch that because that could turn out to be some real strong overhead resistance at 335.27. Okay, these moving averages are starting to trend down and coming right into price. That's good. But price can go right up to these moving averages and get rejected, okay? I'm just telling y'all. Price, we can break above our weekly Bollinger Band pivot point. We could get above and stay above the 8-week moving average. Yes, volume can start coming in. But when you're seeing these downward trending 13-week, downward trending 30-week moving averages, okay? We got the 30-week right over his head, this royal blue line. I'm telling you, prices could run right up to these levels and get rejected. Hopefully it holds support at the 100-week right here. Hopefully it holds support at the 100-week or the 4-week moving average. It holds support and rally back up, but this can be a rejection point, okay? This 13-week, these 30-week moving averages right overhead can cause prices to get rejected, okay? So we could go down and look at the daily chart. But I'm going to tell you something. It really doesn't matter because whatever the daily chart is saying, the longer term weekly chart commands the most power. All right. So the 13-week moving average, the downward trend and 30-week moving average, which is at 339, the 13-week is at 335. All of this is overhead resistance. Okay. So on the weekly chart, we coming upon some really key levels. Prices can move up, get inside here and stall and get rejected. If it can't get above all of this, we need to be careful. So if we take the pivot point, we know we only got $2 before we could come into a problem. So we need to see that volume and everything coming in on the daily charts, right? Because if not, you see you ain't got much to go before you run into some serious overhead resistance, all right? And if that's the case, if that volume is not convincing enough, then we're probably just going to wait until we could clear these levels, all right? And then we use these levels as possible stop losses and see if we could get above the 200-week, okay? The 40-week and 50-week moving averages up top. And by that time, we'll be close to the 200-day moving average on the daily chart. So I'm just saying, these are some very key levels. We got to watch it. This is some really strong long-term overhead resistance levels that could be causing a problem. If we get above that, then we're going to be moving up to the 40-week and the 50-week. And that'll be some really key levels at that point. We get above that, then it's a really strong chance that we could be going back to them highs of the yield curve conversion that I was talking about before, going back to the previous highs. So look, that's the DIA. We're going to stop this right here on the DIA. We'll stop now. This will be part 1 for the DIA. We'll look at the SPY and the Qs and everything in the next part 2 of the Weekly Bollinger Band Strategy. That's going to be we'll cover a lot more of the ETFs with that one because I won't have to talk about the the beginning part where I talked about how the trade need to play out. So let's go down to the daily chart real quick. Let's go down to the daily chart real quick. And let's look at that 50-day moving average on the daily chart. Here it is right here. It's at 335.09. Okay. If I expand this, you can see this red downward trend line is at 335.09. Okay, 335.09. That's the overhead resistance on the DIA. That downward trending 50-day moving average at 335.09. Okay, so like I said, that is going to be a level that we have to monitor very closely. So 335.09. If we go back to the weekly chart and look at that weekly 13-week moving average, is at 335.27. So you see that the 13-week moving average, which is the yellow moving average on the weekly chart, right? The 13-week moving average right here is at 335.27. This 13-week moving average, right? 335.27. If we step down to the daily chart, the 50-day moving average is 335.09. 335.09, and on the weekly chart, 335.09 on the daily, and on the weekly, we had 335.27 for the 13-week. So you see how that 13-week and that 50-day moving average is right there next to each other, and the pivot point for the DIA is 332. So we talking about $2 before we run into a really serious overhead resistance levels. I mean, this volume and everything has to be very convincing. Okay, it has to be very convincing. All right, because we're not trying to get caught in a situation where we take a hit, especially when you know that it's only a $2 before you get to the overhead downward trending 50-day moving average, and you already know the ATR, the DIA, the ETF that tracks the Dow Jones, can move $6.50, give or take, in any given day. That's what the ATR level is, 655. So we only got $2 till we get to serious overhead resistance. This thing can move $6 in any given day. We need to see that volume coming in. We really need to see that volume coming in, and it has to be convincing. Okay, so if we take the trade, we know we only got $2 before we get into that overhead resistance. Really strong overhead resistance. And like I said, if we hit that, we can get rejected. We can bump our head and get rejected right there. If it hits that and get rejected, start breaking back below the pivot point, start trying to break and close back below the 8-week downward trending 8-week moving average, then I will probably start reducing and maybe get out of the trade, because it doesn't make any sense to wait for it to come all the way back down to the low of the previous week, which would be that 325.36 stop loss. I mean, I wouldn't have to give up the whole $6 because the trade is not functioning right. I can always get back in if it reverses and head back up, and could get back above that overhead resistance. But why wait and for it to come all the way back down to the 100-week moving average, or the low of our second stop loss, the low of the previous week, when it's already looking like it's getting rejected, especially if the volume is coming in on that rejection. So we got to be careful. This market can roll over from hitting this overhead resistance, the 50-day, the 13-week, and the 30-week moving averages. That's all right overhead. This market can roll over. So that's it for the DIA. Okay, we'll look at the other major index ETFs in part 2. This is part 1 of the DIA of the Weekly Bollinger Band Strategy. So I know in the beginning I was talking about the spreads and everything from last week and this week, because I just wanted to make sure everybody understands that because of this tight trading range of last week, because of how tight. Okay, let's go back to the let me go back to the Bollinger Band instead of the moving averages here. Let's look at the Bollinger Band one. Okay, there's less going on there because of the tight narrow trading range from last week. Because of that, okay, I just wanted to make sure I go over, and hopefully I made it clear for everyone that because of this tight trading range of last week, it made our stop our stop loss, our risk on the amount of money that we can lose, and make that spread from the pivot point to the low of our previous week, which has been our maximum second stop. Okay, it made the risk a lot lower. It's down to $6.71. Okay, so I just wanted to just explain that you always want to try to reduce risk. You always want to try to reduce risk and protect yourself at all times. Okay, proper money management, risk management. You always want to have that in play. Okay, because the market can do a lot of damage to you if you're not using proper risk management, proper position sizing, proper risk management, risk control. We got to be careful. Okay, so look out for part 2. We won't go through all of the stuff we did in the first part of this video, because I think that's kind of clear, the difference between the spreads. What I just talk about is what the spread is going to be now, okay, going forward into next week. All right, I won't talk about so much about the difference between the spreads, all right, from before, when the strategy was first setting up, to now how it looks now, because this is the third week into the setup now, so it's looking a lot better. Okay, but I won't go into all of the stuff in the past. I'll just be talking about what the spread is going to be now, and what our risk is, and what we need to look out for on the second part, which we'll be going into the SPY and the QQQs. Okay, see you on the second video.